Hello traders, how you doing today? Happy Tuesday to everyone. Please give me some okay. Almost, Ivan, almost, not there yet, not 35 yet. only in 2 days. So how you doing, guys? Good to see you. Thank you very much for making it. Today I was trying to find the hour that will fit. But yes, of course, it's impossible to fit everywhere every single time. The world is round in a circle. That's what they say, right? So, Tuxman, watch a webinar from the bed. Lucky you. I wish I could present one from the bed, but it would sound different, I guess, and weird. Anyway. All right, thank you very much, guys. So it's very good to see you once again. Thank you for making it. And I hope, as always, the quality that I am looking for would be as you expect. Basically, today's webinar is about multi-time frame divergence trading concept. Now, we are talking about divergences and cycles combination many times in the live rooms, well, every day, because this is my trading style, and that's how I believe that the real money flow goes, with all its exceptions here and there. So today, my idea is to present the multi-time frame divergence trading concept and mainly clean the doubts, because in some periods there are lack of clear scenarios with cycles, because cycles is much harder technique. It's based on mathematical levels, and it's much harder to apply that correctly and go as a roadmap between all the time frames. So the idea of the divergence multi-time frame trading is basically to simplify that a bit, what you need to pay attention to if the cycle reading is not clear, because sometimes the cycle is amazing read, obvious, and sometimes not, right? In that case, there always has to be alternative. There is no one ultimate tool to be able to deal with all the market different conditions, right? Because the market conditions change. It's like there is no one ultimate transportation possibility for all weather conditions, for all traffic conditions. For some different things, different vehicles or flying methods would fit more, right? So same here, and that's the idea. Now, Jordan presented back then the principle of matryoshka. Was it too Russian accent now, matryoshka? Can you say it like me, matryoshka? Well, if yes, sorry, that's it just brings me back to to my childhood. So just make it smaller here. Okay. So the idea of the matryoshka is to scale down in specific given divergence and watch out for breakouts. While this multi-time frame divergence is basically how you handle your trading decision according to market sentiment at that time being, and until when your view is relevant. That's the difference, okay? Because I got asked about it like by email, what will be the difference? It's huge difference. Well, divergence is divergence, so when you start to combine, you still do pretty much the same things. But when you apply that, it's different. So for today, by the way, can you see my screen, guys? Because I see here. Can you see my screen? Because two guys said no screen. Let me just in case, restart it. Should be okay now. Guys, it seems just it's only you. Those who don't see. Sorry for that. Oh, okay. Screen now. Good. So today we'll talk about the main idea of divergence trading, multi-time frame divergence trading principle, what time frames suitable for different trading style, examples, rules, steps. Okay. Now, I just want to be very clear about something. This is not a trading strategy or any specific moving average cross systems or anything like that. No, this concept is to allow you to deal with different changing market conditions and sentiment at any given time. Okay, just want to be very clear here, because sometimes when we hear a webinar, the expectation is, oh my God, I'm going to learn a new strategy. Tomorrow I'm going to make money. It's nothing like that. It's to give you the tool to be able to deal with the changing conditions at every single given moment. So divergence, as you know, one of the most favorite things in my trading arsenal, and also one of the most powerful technical tools exists out there for traders. It's not simple, but at the same time, it's not a real science. Once you focus on understanding the logic of a divergence and not put all your focus on specific rules, so if this is yes or this is not, first of all, understand the logic behind the divergence, what it represents, and then all these puzzle pieces starts to fall into the right place. If you try to just make it like mechanism or any kind of rules, it will not work. Okay, just try to understand the logic. So it's really not a science. Trust me, if the Russian guy speaking now was able to deal with that, everyone will. The idea of a divergence is to show the most recent sentiment in the market. The bearish divergence means bullish power is losing its momentum, while the bullish divergence means exactly the opposite, and that the bears become weaker. Now, as I said before, the idea is not to teach the divergences. I assume that you know the divergence, understanding what it is. You watched the divergence webinars that we have in our media zone, and you understand what I'm talking about. Okay, I'm not going to teach the divergence here. The usage of that, yes. Now, all divergence types are relevant for this kind of trading, which we call the multi-time frame divergence, right? And will be used. It could be hidden, regular, continuing, extreme, whatever it is, it fits. Because divergence is, at the end of the day, a divergence. A situation where the price is in a disagreement with its own mathematics. We call it deviation. That's where divergence appears. What type is it? Doesn't matter. The logic definitely does. The main idea for us is to start from higher time frame and scale lower to find for confirmation and setups. The whole concept will be based on 3 time frames combos. Okay, ready? Let's begin, guys. Now for the real deal. The first step we have to do is to identify the divergence on the highest time frame we will define. That could be weekly, my favorite. That could be daily. That could be 4 hour. Okay, you name it, and that would be your highest time frame you start with. Just remember, the higher you start with, the more reliable, less noisy, based on real money flow, your whole definition will be. The second step is to go to one lower time frame from the highest one we started with and make sure it fits in the higher time frame direction. If it's, boom, we have another lower one to trade. So we go to one lower time frame. If it doesn't fit, then we are waiting for it to fit in or to make a corrective cycle. Sounds scary? That's the idea. So I can explain it later. But don't be scared. And the third step is to fit the third lowest time frame involved in the direction of the higher two time frames. The bottom line of all this scary speech I just had is 3 time frame has to fit. Have to fit. Why has to fit? Have to fit in the same direction. Okay, example, dollar yen recently. What happens recently? Bearish divergence spotted on the daily chart. Right? Let's start with the daily. So daily would be our highest. That means we will need to go to 4 hour, fit that in, right? Make it rhyme, and then go to the 1 hour. That's the idea. On the 4 hour, since this moment, that's where the daily created it, right? So we can start also working with that divergence. It's a bearish divergence by itself at the end of the move. So we can start looking for sells right from the top. That would fit in with Jordan's Matryoshka, for example, right? Okay, that's the principle of Matryoshka. Scale down and find the top or the bottom. I'm talking about working with it and every single given time. So, well, more advanced, yeah. That's true, James. That's true. More advanced a bit, but so we get a move, the initial move, and boom, we have a bullish hidden divergence. Bearish hidden divergence. Now it's the whole idea is that we have lower highs and higher highs on the histogram, right? We also have kind of a bearish hidden on the stochastic, which confirms. So what do we have now? Daily bearish, 4 hour bearish. Looks good. What do we do in that case? We scale over to the 1 hour chart, and from that moment we have to make sure that 1 hour chart is bearish divergence by itself. If it does, which in that case it is, it's also bearish hidden. This becomes our zone to start looking for the sell. Now let me guess, what is the first question running through your mind right now, guys, right? So how do I enter? Where do I take profit? Where do I put stop loss, right? Now, as I said at the beginning of the presentation, it's not a strategy. I'm not teaching you a strategy, where to enter, where to exit, anything like that. This is the principle of the movement, the price movement following the divergence and the flow among all the 3 time frames. How you gonna enter your trade? You can do it whatever your trading style is. Trend line breakouts, last low breakouts, Bollinger Band setups, like I love to do sometimes, you know, the Bollinger Band trading. You can do with moving average crosses, whatever you want. Lower lows to be created, any kind of strategy that you have, you apply in the concept. Okay? Strategies will work, any strategy you have, well, as long as it's logical, will work beautiful for you when you fit it in the real price movement concept. And that's where the divergence come in and the cycle come in, okay? Remember, strategy by itself, non-strategy, will print you money automatically. It doesn't exist. Well, it exists if you belong to the Fed. You can print money as much as you want. Privately, we still don't have it. There are rumors that soon we will be able to do it with the 3D printers, but it's of course a joke. So that's the idea. We fit in all the time frames. We can start looking for our sells. Personal tip. My favorite style is the trend line, but mainly false break and lower lows. That's my style. That's my favorite style when I can fit in everything. Okay, just a tip. Of course, as I said before, anything else fits in as well. So this is the example. We soon will go to much deeper details. The money management principle of all that idea. So the target is normally open until we get opposite sign. What is opposite sign? A divergence against our direction. So if we are selling, a bullish divergence is against us. And if we are buying, then the bearish divergence is against us. Makes sense, right? The logic here is pretty clear. The stop loss is normally based on the lowest time frame because that's our entry time frame. So the entry time frame would be also the management time frame. Okay, in general. Now I do want you to understand one thing. Why do we go to 3 time frames lower from the original one instead of sticking to the original one? The whole idea of traveling between the time frames is to find yourself the possibility of better risk reward entry. If you stick only to the higher time frame, then the risk reward would be a bit worse there. When you go lower, you scale lower, you suddenly find yourself dealing with more frequent possibilities of trading, which is important, but not the most important, and not always the most powerful thing to do. But not just that, you mainly deal with improving risk reward and timing. Triple combo gives you the best timing. And you already know timing is extremely crucial when it comes to trading. So that's about the stop loss. The management main principles are risk-free your trade after you have one-to-one risk reward, or once the opposite signs against you on the entry time frame starts to appear. Why the one-to-one risk reward? Because that's the minimum required for the market to normally, in healthy market condition, start and develop opposite sign. And that's where this rule comes in. One-to-one or slightly more when you have the signs against you, move stop loss to break even. Break even isn't a profit, but it will never be a loss. And there are surprises in the market. Sometimes, boom, news come out and levels cleaned and so on. You don't want to be overexposed to any kind of changes like that. You play smarter. The way I see that, and of course you have all the rights not to agree with me, but that's from my personal, experience after all these years. Break even psychologically is easier to digest than a loss in place where you could not to lose. You know what I'm saying? If you could save your loss, but you didn't, the regret normally psychologically has harder impact and stronger impact and let's say longer impact right after that in our negativity psychological concentration in our trading. Then get closed on break even. That's my personal view. Break even not a profit, but it's mainly not a loss. And you don't improve your performance only by making more money. You improve your performance mainly by losing less. Remember that. It's very important part, guys, which traders unfortunately don't pay attention to, because everyone thinks, oh, I should trade more to make more. And I say the vice versa. Trade less and lose less. Your performance would dramatically change. That's the first thing. The next thing, cash Y hour. You see? That's what happens when you make it's out, okay? Cash out, partial or partial cash out. So full cash out or partial cash out when the opposite divergence appears against you on the entry time frame. If it's partial cash out, then run the remaining part until one higher time frame has divergence against you. But the more important part from my point of view is this. I love to manage my positions always based on total performance principle, which means if you have a good run, don't cash out and don't cash out partials. Just free the risk by moving stop loss to break even and give yourself a chance to enjoy from the potential full move and get the full of the risk reward. But if you don't have a good run, cash out on opposite signs against you is an important step to return to healthy psychological trading. What do I mean by that? You know, there are weeks that you start your week, boom, profit, boom, profit, boom, profit, boom, profit. You feel like the god of Forex. And the confidence skyrocketing. You feel, now I understand the market. Now I finally make profit. Now I can tell my wife or my husband I can leave the job and we start to go to vacations. But hold on, before you do that, guys, before you do that, calm down, relax, and understand that we're talking about a tiny period from a long journey called trading. And this is how our human psychology works. 1, 2, 3, 4, 5 or more good trades at the beginning of the week or the beginning of the month, and we're like, woohoo, party time, right? Let's get some margarita. Calm down at that point, because normally that's exactly the place where the mistake starts to happen. The confidence is so much high, then the focus is exactly the opposite, so much low. Okay, remember that. So in such weeks, when you have a great start, that's exactly the place to give yourself a chance not to improve your day or a week, but to improve your months or a quarter or a half year or even the 1 year. So give yourself a chance. And you give yourself the chance for one reason, because the higher time frames are lined up for you. That's where your probabilities and possibilities to catch much bigger move are high. Alternatively, there are weeks that, you know, we can't run away from that. Sometimes we start the week, a loss, another loss, one profit, one loss, one profit, one loss, right? That happens. How the market would be in a given specific week, not me, not anyone can know. It's only up to the market to decide, right? We have to trade facts. We don't know how the facts will be. We have our plan, which we have to follow, right? But we don't know how it's going to work. And that's exactly the place where the healthy psychology is a very important thing to follow. So if you have this week when you suffered from a loss and recovered a bit, suffer a loss, that's the most important situations to bring in and stay around as close as possible to break even or small profits. Why? Because trading performance goes in a principle of 80-20. 80% of the time, our trading looks like that. Ideally, yeah? Sometimes it looks like that. sometimes like that, right? So we have to try and aim to reach this place where 80% of the times our trading is around the break even and aiming to the small profits. Why? Because at the time that we nailed it and we found it right spot on, right? And we have this week I was talking about right here, then what happens is that you have boom, 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 boom. And if you allow yourself to run these trades in such weeks, there might be 1 or 2 trades that will do this. And then the whole performance would be like this. Boom, 80%. Boom, 80%. Do I scare you with these booms? I hope the kids not hearing me saying, who is this crazy guy booming out there in the webinar? And boom, okay, quiet boom. Okay, so that's the idea. That's how trading goes. Okay, that's the real trading, guys. 80% of the time we are focusing and working on not losing money. 20% of the times you will have these periods that will boost you up. If you know to, if you have this ability to understand that and catch that and remember these little things I just spoke about right now, okay, you will remember that these are the periods to make money. We have the dream that every single week we can make money and so on and so on. It's impossible. And on the periods it doesn't go as we want. The healthy psychology is extremely important right here. So don't try to catch the big fish every single time, because, you know, even when you go to the ocean, in order to catch one big fish, sometimes you need to spend hours or days, and sometimes you even go back with nothing. But you have to go to the ocean if you want to catch the big fish. If you want few small fishes, go to the lake. Okay? Go to small lake, go to the pond, go to, right? You understand my point here. So here the principle of healthy psychology comes important, because, you know, human brain, you can't change it. You need to deal with it. You need to learn to deal with it. We are an amazing boost of psychological input when everything works for us and we feel like woohoo, right? But most of the times it doesn't. The market challenges us. Now it's up to us to decide, are we falling into this challenge, or are we dealing with that correctly? Dealing with that correctly is understanding that this is what happens right now. It's part of the game. The last previous 2 months, when the market was not moving, even long-term traders like I am could not make money, because if within 2 months the price don't change the price, how would we make money? Right? But this is important psychology. For long-term or for short-term, it doesn't matter. Psychology is the same. When you fall into this period, that's where you will want to partial cash out or to cash out once you have the opposite signs against you, not to allow yourself to fall into the dark feelings. One loser, one winner, one loser, one winner would make you break even. Break even is much easier to deal with than a loss that you know you could avoid. On that, you can trust me 100%. Okay, so that's for the money management and the psychological part. Now here is the time frames combination we will work with. Weekly, daily 4 hour, that's for swing and long-term trading. The daily 4 hour, 1 hour, that's for medium and, let's say, guys, apologize, this should be medium, okay, here, and more comfortable trading and yet active enough. On 1 hour chart, you have, and more than enough opportunities for the week. right? 4 hour, 1 hour, 15 minutes, it's short term, and 1 hour, 15.5, that's scalping. Please note, scalping is risky and aggressive style for risk lovers or very big dreamers, okay? And most of the traders fall into this category. I trade more, I make more. It's a normal thing to think at the beginning of the journey. You have to grow through that, this psychology, to understand that actually you will make more money here than here. You have to go through that zone, okay? All right, I think I spoke enough based on some slides. Now let's talk charts. Any questions as for now, guys, before I move on? Is there any question or? Efran, will the presentation? Yes. Well, let me complete the question first of all. Will the presentation would be included in the video? The answer is yes. Okay, so good. All right, so the dollar yen, bearish divergence, as we spoke about before, we saw this example, right? So just want to go deeper into the management part here and the re-entries part here, okay, at every single given time. But just one thing here, one question here comes, can we use 1 hour 30-15? Ali, to be honest, I'm not a big fan of 30 because it stands right at the middle of nowhere. It's not at least 3 times or 4 times lower than 1 hour and not at least 3 or 4 times bigger than 15 minutes. It's just in the middle. So from my point of view, if you don't like the 1 hour, go with 30 minutes or 4 hour and 30 minutes, but not 1 hour 30-15. It doesn't make sense because there will be not enough time for the market to adjust or show opposite signs. Normally, when you see signs on 30, you will see on 15 and so on. Okay? Okay, so that's the idea. All right, so dollar yen, daily, bearish divergence, we are looking for sells. As I said before, we could start to look for sells here. This is based on the Matryoshka principle that Jordan presented, right? We can scale down and look for some entries there. But I'm talking about different things. But we can now look for continuation. As long as the daily is bearish, basically, we can look for continuation, right? So here we got the bearish hidden divergence. So far, so good. Daily is bearish, 4 hour is bearish as well. And we scale down to 1 hour, and 1 hour is bearish hidden as well. Now, if you remember my first slide, well, second slide, I told you guys what kind of divergences you include here. It doesn't matter. Divergence is divergence. It could be hidden and hidden, it could be hidden and regular, regular and hidden, it could be any kind of combination, as long as all the three have that. And for all those who think, okay, so if 4 hour is hidden and 1 hour is hidden, where is the regular fits in or continuing fits in? Simple. This is the hidden, so we need to confirm on lower time frame, 15 minutes. And here you will get double top and bearish divergence on the lower time frame. Okay, so for us, we start to sell from this area. How? With your strategies you use. I said which is my favorite, right? I love the most this situation, and I love also trendline breakout, ideally after false break, Now remember, we have the 2 candles rule, right, which has to be applied in everything, but I'm not going to teach it here. We have separate webinars for that. Okay, but my thing here, my idea here is you understand divergence, you understand how you filter them, the good, the bad, in the moves, right, in terms of the moves. So we are for sales. Until when do we manage our trade? Until the 1 hour starts to show divergence against, and it happens right here. That's the place where the divergence on the 1 hour appears. Why the 1 hour? Because this is our entry. What do we do in that case? Remember the management part? If you have an awesome week, then you just move stop loss to break even and you are free to go until higher time frame, one higher time frame, will give opposite signs. If you need to make the money to improve your performance during this week or a month, right, or the day, everyone with his or her own trading times, then you cash out. Very simple. Partial cash out could be applied as well, and then the rest could go with the higher time frame. That's the idea here. Okay? Now, at every single time, we need to check what happens on the higher time frame. And if we go to the higher time frame, we figure out that not just the 1 hour came divergence, but also the 4 hour. It is a divergence by itself here. Double reason to make the money. Now, what do we do in that case right now? Right here, guys, what do we do? Think about it this way. The last divergence from daily was bearish hidden. So what should be the next step for us? Because the 4 hour now is bullish. I'm talking about this blue cube, right? Daily is bearish, 4 hour is bullish. We need to wait for the 4 hour to become bearish again, to fit in the daily divergence. Now take a look what happens at that very time right here on a daily chart. It is a bullish hidden divergence. Boom. Now it changes, right? It's a bullish hidden divergence from the daily and bullish divergence on the 4 hour. So can we actually go and trade this rally? Of course, if the 1 hour chart will become bullish as well, right? But my principle here is to show you how we continue for a sell. Think about it very simple. If this is bullish hidden, then the 4 hour must be a corrective cycle. Very simple. You have a hidden divergence on a daily, 4 hour must be corrective cycle. Corrective cycle could happen only in two variations. One, two waves, two, correction. So we go back to the 4 hour chart and we figure out that we have here both two waves and a hidden divergence. And now it fits in again for further sell continuation. Now 4 hour is a corrective cycle, we can expect the sell continuation, but 1 hour must fit in again. So 1 hour must be a divergence by itself at the end of the rally, right? And it is. Only when we have this combo, we can go back to sells. Very simple. Well, when you understand the logic, right? Now it looks possibly scary. So step number one, what the highest time frame does for us. You know what? I have a summary for you here. Let's go here. Step number one, daily bearish hidden divergence. The daily bearish divergence. We are looking for sells. Step number two, Step number two for us was 4 hour turn to be bearish hidden divergence. Boom, fits in the daily direction. 1 hour chart fits in. We have the V to go and sell. Money made as 1 hour and 4 hour both became bullish divergence. At the same time, the daily became bullish hidden. 4 hour became bearish hidden for the second time after two waves correction. Why it's important? because daily was bullish hidden. 1 hour chart fits again, and now we have again the road to go. Is that okay, guys? Now, there might be a question arising. So, Vlad, if that was the last bullish hidden divergence, why would I go and look for sells here, right? That might be a very, very good question running through some of the minds. The idea is very simple, because one higher time from the weekly is bearish hidden divergence. That's why. So based on the weekly, we are after sells. And for me, I'm combining weekly, daily, and 4 hour. That's the sells. And for those who are watching the live rooms, know that we are after sells since here. Right? That was the idea for this. You understand where it comes from, guys? It all derives from this combination. Okay. Now I want to answer a few questions came here. Sajid, yes, as I said, that you said you didn't get a regular divergence on the 1 hour chart on the dollar yen. That's correct, but any kind of divergence combination could be in play. If you have hidden on 4 hour and hidden on 1 hour, make sure that 15 confirms your 1 hour hidden. Okay, that's the idea. You scale lower, but the combination could be any. Okay. Ahmed asking, must we see divergence on both histogram and moving average? No. From my point of view, the answer is no. Jordan is much bigger fan than I am, all related to the moving averages. From my point of view, divergence is divergence, logic is logic. And when you have the combination of 3 time frames, it's amazing. Guido, will the webinar recording? The answer is 100% yes. Let me just double check so there are no some, yeah, it is, some surprises. All right, so we spoke the dollar yen. Let's continue to the next one, Euro Canadian. Bearish weekly divergence, which means we are looking for a sell. Daily fits in, right? So we must make sure 4 hour has to fit in as well, and 4 hour does fit in here as well. Now this is the principle of the matryoshka that Jordan presented in his webinar back then, right? You have it recorded, of course. From the very top, we apply the matryoshka principle for the sell. I care about here. So we start to have divergence against us. If we are in sells here, this is our time to what? To make money. Partial, full, or just stop loss to break even. We are waiting for the correction. Here, now we have bearish hidden divergence. So what combination we have? Weekly bearish, daily bearish, 4 hour bearish hidden. How do we confirm that? We can go to lower the time frame and make sure we have divergence there, and boom, attack. So we start our sell plan right here again. We remain bearish until what happens? We don't have divergence against us. And we have the divergence against us only here. Now, if you take closer look, that looked like a divergence, right? Correct? Now, the thing here is that there was no 2 candle rule. So I don't treat that as a low. It's not a low for me. As I said before, I assume, guys, you know the 2 candles rule principle and the divergence idea, right? So I'm not going to teach it here. So basically, that's the idea. It's one straight move. The divergence started to appear only between these lows. And this is our place to ask ourselves, okay, so I have a divergence here. What happens with the higher time frame? And the higher time frame at that very point makes it what? Bullish hidden divergence. What should I do in that case? I have to take the money from my 4-hour chart. I have the signs against me on 4 hours, signs against me on daily. Why on earth I would go and not make money? Make sense, guys? 2 time frames against, cash out. Now, if this daily is a hidden divergence, as we said before, after that, what should happen? Corrective cycle. So 4 hour must be corrective cycle. Corrective cycle could happen in one of the 2 options, 2 waves or a range. In that case, right from here, it happens in 2 waves. And the divergence comes in play. Boom! I have another big, you know what? Let me switch from boom to bam. Bam! So it's not getting not getting boring with the boom. Bam! We have another sell opportunity. So right from this area, it fits in again. Weekly bearish, daily was bullish, finished with a corrective cycle from the 4 hour. We're back to the weekly bearish, and we have the continuation down. Okay, this is the idea. So we start to sell here once again, and up, what happens? We start to see a divergence again on the moving averages, right? Not histogram, moving averages. Fine. Wherever it happens, it's a sign that something happens. What do we do in that case? What do we do in that case, guys? Very simple. We basically make the money. Partial cash out, full cash out, it doesn't matter. Okay? It is based on your money management principle, which we spoke before. If you have a great week, let it run. Go check on daily if you have any opposite signs against it. Okay? Like here. This is the 4 hour, this is the daily. Okay? If the daily is also against, then you completely make the money. It's not just the 4 hour against you now, it's the daily against you now. Make the money. And now it's our time to ask the question, okay, so if the daily is also bullish right now, what do we have on weekly? And on the weekly, at that very time, we have a bullish hidden divergence. If the weekly is a bullish hidden divergence, daily must be corrective cycle. What is for a corrective cycle? 2 waves or a range. In that case, 2 waves happen. And then bearish divergence appears. Okay, it's a bearish hidden, which turned to be bearish continuing, all the combos you want. What do we do in that case right now, guys? Scale lower to 4 hour and make sure we have 3 time frames combined. Boom, 4 hour is also a divergence. So we are back to sells. You see how we scale in every single time, guys? Every single time. What happens on the 3 time frame? As long as there are no opposite signs, we are free to go. How big will the move be? No idea. We can't know. We can't know how big move will be at any given time. There is no way to predict. Don't waste your time don't waste your time trying to predict what's going to happen. I know many traders say, okay, there is trend line, there is support, there is pivot, there is schmivot, there is grivot, or whatever it is. All that is good, but the levels mean nothing. Nothing if there is no signs confirming it. And these signs confirming a level is basically the divergence. Level has its reliability and validation if there is divergence around it. How many times you saw extremely important pivots, weekly, monthly pivots, or psychological levels, or trend lines being broken like nothing? Did you ever wonder why it happens? Did you ever ask yourself what time frames, what trend lines are actually, or pivots are actually respected? The answer for that would be the ones that are confirmed with the divergences. Well, cycles as well, but it comes together. Divergence and cycle come together. Okay, guys, so we scale through the 3 time frames every single time. And as long as we don't have opposite signs against us, we're free to go. How big would be our dinner in a given trade? We never know. But my little tip for you, when you have signs against you, or when you have especially 2 time frames against you, don't try to be a hero. Make the money. Okay? Summary of the Euro Canadian. We started with the weekly bearish divergence. We confirmed the daily divergence on the daily, right? 1, 2. 4 hour fits in. We started to sell. We started the sell and we hold it all the way until 4 hour and daily became bullish. Boom, money made. We then wait, because the daily is now also against us, we are waiting for corrective cycle. Corrective cycle could happen on 2 waves or a range. It happened on 2 waves. We start looking for sell again. Again, we have a fit, weekly, daily, 4 hour. Until the moment that both 4 hour and daily showed the divergence again, and weekly became bullish hidden. And that moment, game over. We are waiting for corrective cycle on the daily. Right? Always one following time frame. Always. Daily became corrective cycle by 2 waves. 4 hour fits in. Boom. Or bam. You decide. Okay? So that's the idea. And we have S or SS, like my friend called it. We have an ace and ace situation. We have the okay to start trading again. Good enough? Now, let me ask you a question, guys. If the weekly is a bullish hidden divergence and daily is bullish divergence, can we actually scale down to 4 hour and buy here? Of course. Of course. As long as the combination holds. At the moment that daily became bearish, game over. Okay? All right. So if you thought I will leave you without a scalping or short-term trading idea, you know I will not. I know many traders are for that. So here is an idea. 4 hour bullish divergence. What do? Scale to 1 hour. 1 hour is a divergence. What do we do next? Scale to 15 minutes. Now it's going to be noisy. It's 15 minutes, guys. Okay, 15 minutes. So here is the thing. After we confirm 15 minutes also fits in the 1 hour and the 4 hour, and it happens here, bullish hidden divergence, we start to look for buys right here. Here we get another bullish hidden divergence, another opportunity to have a great ride. Now you see that? That's what I'm talking about, and I show it for you in a purpose here. 15 minutes could bring that with immediate, sudden moves, zigzags, noisy situations. Yes, that could happen also on the 1 hour and 4 hour, but it's much rarer situation. How do you say more rare? Rarer? No, it's impossible. Too confusing. More rare. That's something I didn't hear here. Anyway, less frequent noisy situations to deal with. Okay, guys, so that's the idea. Once again, we fit in all the way between the 3 time frames. And how long do we hold it? Until we get opposite divergence on the entry time frame. And the opposite divergence, believe it or not, after all this craziness, boom, 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 after all that happened right here only. At that very time, not just 15 minutes was divergence, but also 1 hour became a divergence. Is it good enough to make the money? 100% yes. 2 time frames starts to be bearish. So we expect a corrective cycle on the 15 minutes in order to be able to start buying again. Corrective cycle could be range or 2 waves. In that case, it is a range, but also at 2 waves, 2 big waves and 2 small waves, finished with bullish divergence. Range and 2 waves, classical condition for a corrective cycle. Happened, we can start buying again. Okay, and look what happens on the 1 hour chart. It starts to make also a bullish divergence. So after this ranging correction, it's now also a bullish divergence condition, not just a range. And voila, we can start moving all the way and trade again. Okay, now we run here free without any divergence again. What do? Let's assume we got our entry somewhere here. Or we did the style I prefer, we got a false break and then the break of the high. What do when we have 1-to-1 risk reward? Especially on short time frames. What do we do on 1-to-1 risk reward? Stop loss to break even, at least. Partial cash out could be also in play, of course. Full cash out could be in play, depends on how your week or months go, right? Or day goes. But at least stop loss to break even. Why? Remember the psychological impact I said before? Because here the stop loss would be killed. If you don't move your stop loss to break even, you would end up with losing here. How does the psychology goes when you have a losing trade instead of a break even or possible profit? How does the psychological impact goes? The immediate reaction of our human brain, especially the beginning stage of trading, is to revenge. It's like, oh my God, how stupid could I be? I have to take the money back. So what did Vlad say in this webinar? So can I go and buy now? Right? You start to run multiple situations in your mind, in your brain, just to find the okay to get your revenge, because you didn't risk-free your trade, because you didn't save the money where you could have. You understand this mistake right away, especially this when it happens. It's like a clearance, and it's like it drives us crazy, right? We immediately say, oh my God, I have to buy. What did Vlad say? It can go higher, right? It looks higher, let's buy, or anything like that. And you understand that this is normally the place where it's like a snowball. One after another will lead you to make more frequent mistakes. And that's why I always say, guys, break even might be not a winner, but it's mainly not a loser. And in times where you could save your loss but you didn't, the negative psychological impact is much stronger than the positive one. You feel much more psychologically hurt in that situation than you feel psychologically encouraged when you did a good action. The negative psychology has stronger impact. That's our human brain. And the best proof for that is, you know, when someone tells you 9 amazing compliments about your personality, but tells you just one bad thing about your personality, what do you hear? You hear that he said one bad thing about you. Not 9 good, but 1 bad. That's what we pay attention to. That automatically, right? That's the human brain. And same happens in trading exactly. You understand it, guys? And that's why I always say control mainly the negative part. How allow yourself to have less negativity. When you have the control over the negativity and you drop that to the lowest level, you allow yourself to enjoy from much more frequent profits. Okay? So I hope it makes sense for you guys. Now, before I go to the summary here, I would like to explain a few questions here. Actually, I have one. So, Robert, didn't we have extreme divergence at the end of the arrow? Even here? Do I understand correctly? Yes. Well, you see the time frame? From my point of view, extreme divergence in 15 minutes does not make any sense. It's too noisy. So from my point of view, 15 minutes extreme, nah. In that case, it looked like, okay, great reason, right? But generally, nah. Okay. All right. So back to the summary, guys. The trading principle, this principle, which we just saw, must be applied with 3 time frames. The main one, the biggest one you choose, is your main direction. That's your money flow. The middle one confirms the expectation. The lowest one allows us to trade with minimum risk and maximum potential reward. Management must fit your personality and comfort of trading. I know a lot of traders that are completely good with pure risk reward management or have no issues with holding position based on higher time frames. Great. I know more traders that are so impatient, so in love with the frequent action, in, out, out, in. Whatever your personality is and you have your comfort, fit it to your style. Don't fit your personality to trading. Fit trading to your personality. For some traders, trailing stop losses is amazing solution. For some, just move to break even. For some, cash out quicker in one-to-one risk reward is better than holding. That's all okay. It has to fit in your style, in your personality. You have to be comfortable with what you are doing. It's very important for successful trading. If you're not comfortable, how can you enjoy the trading and make it successful? If you sit on a rock watching a football game, would you enjoy the same way as you would sit on a sofa or a beanbag? No, right? Or in a bar with some beer. You would not enjoy the same way. So it has to fit in your comfort zone. Then you can be at your best. When you are at your best, good things tend to happen to trading. When you are not in your best conditions, with all the surroundings, bad things tend to happen. So good things versus happen in good surroundings, bad the vice versa. Okay, to cash or not to cash depends on your performance. At least that's what I apply to my trading style. Remember, and that's very important, in trading the most important thing is to make money, not to be right. Most traders, especially at the beginning of the way, just want to be right. The ego I was right, not this guy. I was right, not that guy. I know better, right? The ego. Mainly it happens to men, less to women. Each time you plan to enter a trade, you must make sure that none of the higher time frames has divergence against you and has a free road for your trend and momentum ride. That's why it's triple time frame. And remember Uncle Vlad's saying, if you don't pay attention, you will pay money. What do I mean by that? Pay attention to the little details. The devil is in the little details. Here is the main important thing. The trio has to be free to go. If you don't have the time frames, if you don't have any of the time frames against you, your chances are way bigger to end up in profit than in any other condition. If you don't pay attention and you just say it will be okay, you will just pay money. As simple as that. Practice, practice, practice more and more and more until the concept sits well in your mind. And you have to remember, on presentation, everything looks like, wow, this Vlad is awesome, right? The reality is the one that challenges us always. You become perfect when you basically go through all the possible scenarios, do the mistakes, do the checklist for yourself, ask yourself questions, ask us the questions. That's why we have the groups in the Traders Academy Club, right? You will be answered. You know we never ignore, ever. Okay? Go through that, practice, and let that drop to the right place in your brain. And remember, higher time frame requires less babysitting on the chart and more freedom and less noise. And despite me saying that, you would still go and scalp tomorrow or even today, right? Of course, it's just a joke, guys. I just say that so you can remember. And trust me on that. I started my way up on scalping, so I know exactly how that different. I wouldn't allow myself talk if I wouldn't go through all that. I did. And that's why I allow myself to talk from experience. We all want to trade for the freedom. So give yourself the freedom. Higher time frames, allow yourself more freedom and less babysitting. Okay. Quick answer for a few questions above. Where is that? Aristarchos, when have different divergence on the higher time frames, then the secret number 3 fits in? Well, secret number 3 is from divergence webinars, okay? Everything would fit in when you have the 3 combinations, as simple as that. Okay, all the rest would fit in. Said, is divergence into convergence is valid for shift in momentum? Yes. The switch from moment, that's why I said before, if you remember, let me just quickly find that. Where is that? Here. On my favorite style, I love to do like false breaks, right? So let's say if we had a, well, you don't have here, let me just find this example where we did. Where was that? Here. Okay, so for example, we got that movement, false break, boom, right? And it fits in all the time frame, perfection. That's exactly what I love to do. Okay. Okay, guys, Willem, thank you very much for your great words. I hope you enjoyed the webinar and things become clearer for you. If they don't now, I hope they will after you watch it again. Very, very, very big tip. Try to apply that in your trading, guys. Remember, strategy would make you enter the trade and exit the trade, right? It has its own rules. But trading is not about clicking yes when you have the alert. Trading is understanding what the hell happens on the market. And the best way to do that is to ask yourself the questions, what happens on the higher time frames? As long as there is nothing against you and you have this combination between the time frames, you are in the right time to trade. When different time frames start to give you different signals, avoid your trading. So once again, thank you very much for being here, guys. I hope it makes sense to you. I hope it's clearer and I presented it clear enough for you. Thank you for being here. I wish you a wonderful day, and thank you once again for your wonderful support and feedback. I'll see you in the groups, guys. Thank you. Take care.